Were you aware of how much you should really pay for Tesla stock? While there are a lot of Tesla stock valuations from various analysts and investors, which of them are most plausible? Stay tuned and keep watching to find out. Some say that Tesla stock is overvalued, while others give extreme price predictions for the stock for the coming years. Normally, the stock market is quite difficult to predict, but even more so today with the world's current economy. It is no secret that the COVID-19 pandemic put a lot of businesses on hold, and many are just starting to get back on their feet now. In today's video, you will find out how much you should really pay for Tesla stock. During the first quarter of 2022, Tesla recently announced it delivered 310,000 cars. Although that was a little short of Wall Street estimates, it's 70% up on the same time last year. It's a lightning pace of growth matching the soaring Tesla stock price. Now, the question arises, how to value Tesla stock? Jumping into the future to 2032, there is a three-step process. The first stage is to guess Tesla's sales and profit. The second is to assign a stock market multiple to the forecast profit to give us a theoretical future value for the company. The last step is to convert the future value into the present and compare that to the current market value. The first step is forecasting Tesla's future. There are around 90 million cars sold worldwide, and the number of EV cars is growing rapidly. By 2030, around 25% of all car sales will be EVs, according to statistics gurus at IHS Markit. Given that most major car makers are planning for higher than that, it is not unreasonable to use 33% in 2032 future predictions. If car sales grow by 3% a year, which is a rough estimate of global GDP growth, then in 10 years the world's car makers will ship 133 million cars, and at 33% penetration, that would be 44.4 million EV car sales. Estimates of Tesla's current market share vary. It is much higher in the US, for example, than in other parts of the world. Statistica reports that Tesla accounted for around 20% of global EV sales in Q3 2021. Assuming Tesla holds a 20% share, then in the future it will sell roughly 9 million cars. As of today, the average price of a Tesla car is around $60,000. It's difficult to know whether this will rise with inflation or fall as Tesla introduces cheaper models. So, assuming it stays the same, Tesla could sell 9 million cars at $60,000 and make $532 billion in revenue in 10 years. From a profit perspective, the company currently generates a profit before interest, tax, depreciation, and amortization (EBITDA) margin of 17%. Again, assuming this stays the same, in 2032, the company might generate $91 billion in EBITDA profit, 17% of $532 billion. Since the next step is to assign a stock market multiple to the forecast profit to give us a theoretical future value for the company, it is worth asking, what value will Tesla be 10 years from now? The next step is to pick a market multiple to apply our forecast EBITDA to calculate the value of Tesla in 2032. This is mostly guesswork. Tesla's current multiple is no help and can't be used. It is too high because it reflects the rapid growth people expect. Other car companies trade on a multiple closer to 10x EBITDA. Tesla's multiple is likely to be higher than this. The company has more going on than just cars, and some of these other businesses might turn out to be hugely successful too. Taking a 15x multiple to reflect this and applying that to the $91 billion of forecasted EBITDA profit would yield a future company value of $1.36 trillion, which, using current shares outstanding, would yield a stock value of $1,311, roughly 40% higher than today's level. Note that this figure is 10 years from now and needs to be converted into today's value, so a little more guesswork is required. Finally, the last step is converting the future value into the present and comparing that to the current market value. How much is Tesla worth today? To convert a number in the future to today's value, you need to divide it by a discount rate several times. 10x in as an example while looking 10 years into the future. The choice of discount rate requires more fingers in the air, but a sensible number is 7%. Using a 7% discount rate calculates a present value for Tesla of $690.1 billion, or a stock price of $655. But that's 30% lower than today's $986 billion. Imagine instead of EVs being 33% of all cars in 10 years, they are 50%. That's not unreasonable given that most major car companies are targeting these levels for production. If everything else was kept the same, the calculated fair value today would be much higher. In fact, it would be almost magically identical to the current market value of $986 billion, implying Tesla stocks look fairly valued. On the other hand, assuming Tesla grows to a 30% market share in 10 years instead of 20%, the calculated value would be pretty much the same as today's $986 billion. Meanwhile, assuming both 50% of all cars are EVs in 2032 and Tesla has a 30% share, which would yield a stock price 40% above the current value. What all this does is demonstrate that valuing stocks is an art and not an exact science. No one knows what will happen, but these exercises can be very useful to gauge some sense of how the market is thinking about the company's future. While Tesla bulls will argue that the optimistic scenarios suggested are not just plausible, they are probable. Bears will argue the exact opposite, but that is what stock markets are about. Do you think Tesla stock is undervalued or overvalued? Let us know what you think by leaving a comment below. Here comes the next question. Should you buy Tesla stock? Although it is hard to predict the future, one thing is almost certain: electric cars will be more popular tomorrow than they are today. The recent surge in oil and gas prices will likely cause seismic shifts in consumer demand and vehicle preferences. Many people are paying almost double what they did a year ago to fill up their cars and trucks. Oil prices are unlikely to decline anytime soon. With demand outstripping supply, it's a major reason why the world has been blanketed by extraordinarily inflationary pressures that have prompted central banks to raise interest rates, which have sparked fears of a global recession. Even when the EV company stock has been experiencing a dip, Kevin O'Leary said that the best time to invest is when everybody's going the other way. He compared this move or strategy to the lemming effect. Lemming effect in psychology refers to a phenomenon wherein crowds of people across various fields of life exhibit a certain kind of behavior for no reason other than the fact that a majority of their peers do so. O'Leary is a Canadian businessman, entrepreneur, author, politician, and television presenter. He is the chairman of O'Shares Investment Advisors and Beanstocks and a strategic investor, and is known as Mr. Wonderful on ABC's Shark Tank. We're beginning to believe that not only will Tesla take the biggest share of the electric vehicle market, we also believe that it could take 20 to 25% share of the total auto market in 5 years. That's by 2026, says Cathie Wood. Wood is an American investor, a star stock picker, and the founder, CEO, and CIO of ARK Invest, a company with $60 billion in assets that invests in innovations like self-driving cars and genomics. In a recent video, Wood explained how investors have the chance to become a millionaire by holding Tesla shares until 2025. Wedbush analyst Dan Ives is a well-known Tesla bull. Daniel Ives is a managing director and senior equity research analyst covering the technology sector at Wedbush Securities since 2018 and has been on Wall Street for 2 decades covering the software and broader technology sectors. He continues to list the company as one of his top tech picks. Despite Tesla stock's recent trading performance due to China's zero-COVID policies, which created both supply and demand disasters, and Musk's controversial Twitter deal negotiations, Ives believes Tesla should begin to see some progress as both production and demand issues become resolved in China. Tesla stock is probably a wise choice if you're looking for a solid stock whose future growth is widely accepted. Tesla Group is taking advantage of the global green transition as the world's leading electric vehicle company. Although its stock is not a yield stock as there is no dividend, it can enhance your portfolio to realize an interesting capital gain in the long run. As mentioned, stock prices are always fluctuating, whether up or down. That said, there are several reasons why Tesla shares could go up. 1. The EV company is a leader in energy efficiency. 2. The company embraces innovative ways. 3. It has a strong brand image. Tesla also has promising future technologies and is committed to the ecological transition. Finally, is the company's battery development. On the other hand, there are also reasons why Tesla shares could go down. First is its weak international presence. Second is the company's high-end products, which can cause some sales problems because it only reaches a small part of the consumers. The third is strong competition. Another is high operating costs as well as low long-term visibility. Of course, no one can really predict the future 100%, and these are educated guesses made from available data. Additionally, investing is a risk in and of itself, given how much the stock market changes in just the blink of an eye. Still, a lot of established investors believe Tesla is worth the risk, as it has a great potential to succeed more in the near future. Watch our other videos on our channel if you enjoyed this one.